Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. My name's Chad Frantzen, and I want to personally welcome you all. I know some of you are existing clients and friends of Wealth Builders Investments, and you follow us on the Kingdom Finance Show. And some of you, we've just been introduced. You may have ran across us through some of our different platforms that we're on. So either way, I want to welcome you all and thank you for being here on behalf of our entire team at Wealth Builders Investments and the Kingdom Finance Show. I'm your host for today's webinar, Chad Frantzen. I'm a certified financial planner, and I'm the CEO and founder of Wealth Builders Investments, which is a registered investment advisor. And we also have a podcast. You may have run across us out there in the social media world called the Kingdom Finance Show. And every week we come out with content to give you an update on what's going on in the markets. And really our heart is to equip you to bring clarity out of chaos when it comes to the economy, the markets, and how to create your own personal financial plan that is in alignment with your values that can help not only your generation, but the next generation and hopefully generations after that. So that's really our heart. And what we do here on this particular webinar program, we do this once a month where we invite folks to come join us. And I'll give you some ground rules here as we get started. And we've got more people coming into the room. So again, I'm just kind of giving a little introduction here before we get rolling. Really, the goal here with this monthly event is we want to have people participate with us live and ask questions and kind of interact with us a little bit as we're able to on webinar platforms at least. And this, we call this the economic update. And so really, with my background, I've been in financial services and investment management for going on 22, 23 years now. Hard to believe that. I have a background as a board certified financial planner. And what we have done for years and years is just work with families all over the U.S. to manage their resources, to plan for the future, to think through hard questions when it comes to tax, when it comes to retirement, when it comes to how do you invest and not violate your values or your biblical worldview. So we try to really address a lot of those things. So this program today, I'm going to spend some time. I've got a slide deck prepared, and it's really, we're going to give you an economic update of what's going on. And so before I jump into that, kind of ground rules for it, I do have a couple poll questions I'm going to put up here on the board here in a minute as we get started. And the slide presentation, I am going to make it available to you, so don't feel like you have to scribble notes furiously. I do have quite a few charts today. My business partner and friend Billy Epperhart loves to use charts, and so I'm very similar in that regard. But don't worry, I'm going to give you a link at the end of the webinar where you can download the handouts from today's webinar. You also will receive this webinar a recording link. So if you have to jump off early, or some of you may have registered and you weren't able to come to it just because of a timing issue, you will get that. So every month we try to do this around the second Thursday of the month, kind of our economic and market update. So this is our second to last one for 2023. We'll do another one in December, and we'll talk a little bit more next month, our forecast for 2024. And so we have some year-end thoughts today, and also some really, really important economic information has come out this week. And so I'm happy to kind of present that and give you our thoughts on that. Also, at the end of the webinar, I am going to give you a way to connect with us directly. Some of you have never visited with us before at Wealth Builders Investments. Some of you are longtime clients or friends of ours. If you want to connect with myself or our team, just ask personal questions on, hey, Chad, I didn't understand that. Can someone on your team help me really get my arms around my financial situation, or give me an update on my portfolio if you're a current client? I'm going to give you a link on that at the end. And we did open up some slots here that we hadn't opened up before for meeting times. Again, we've got Thanksgiving and Christmas and end of the semester for school all rolling up, but we wanted to make sure we carved out some time for you all. Well, let's get started. So what I'm gonna do, I'm gonna share my screen here for the webinar, and I'm gonna go through the slides. I'm gonna teach on kind of 3 or 4 main points of what's going on in the markets, in the economy. And then I'm gonna finish, if you hang around with me, I'm gonna give you kind of our playbook of some of the things we are doing right now with the clients we work for. And so some of you, this will be a refresher on some things we've talked about one-on-one. For those of you who are new to Chad and Wealth Builders Investments, this will give you an idea of how we approach investing, financial planning. How do we think about these type of topics using what I call a kingdom framework or biblically conservative values on that. But primarily today, we're really going to dig into the economy and the markets, what's going on, a lot of new information that came out this week. I will leave time for question and answer. So you do have a box there, a chat box. Just one last piece of instruction. You do have a chat box. So if you have any questions, please go ahead and enter those into the chat, and I will do my best to answer a handful of those at the end for us. And, prefer just keep them, centered around the financial questions, investing questions, economy, and I'll do my best to answer those. So please enter those. I want to answer as many questions as we can. All right, well, let's get started for this edition of the November Economic and Market Update from Wealth Builders Investments. All right, I'm going to go ahead and share my slide here. On that, I will make this available here at the end of the program. Again, our investment firm is called Wealth Builders Investments, and I'm the CEO and founder. As I mentioned, we've got a team really all over the U.S. That work with folks in various states to help them personalize creating a financial plan and really applying principles that we've been using for over 20 years to build wealth, to protect wealth, to minimize your taxes, to be generous and leave a legacy. So we're really excited about the work we're able to do and really view it as an opportunity to serve on that. Again, today's webinar is for educational purposes only. And again, a lot of the charts I've pulled from third party, open market information. If you want specific investment advice, encourage you to connect with us one-on-one, but I do hope you'll find this of value today. All right, if you haven't before, we would love for you to follow us on the Kingdom Finance Show. We're on YouTube, Apple, Google, Spotify, you name it. We put out new content typically every Tuesday. We drop a new episode, 20 to 30 minutes, kind of evaluating what's going on currently in the markets. Going into 2024, I'm excited to announce we're going to be bringing on special guests to interview them, different investors, entrepreneurs, just people, men and women in the financial and business industry, and really just pick their brain on how they have used their God-given abilities to steward businesses, to steward wealth, and how can we learn from that. So you can snap a picture of the QR code there, or you can just go out and search Kingdom Finance Show on wherever you like to view podcast. And would love for you to subscribe to that. It's a great way to connect. One of the big questions I get from clients is, how do we stay connected with Chad and the team? This webinar that you're attending and watching today, this is a great one. And then every week we're on the Kingdom Finance Show. And that's really like, getting an inside look at what we're thinking about, how we're viewing the world, how we're interpreting it for our clients. And again, our goal is really to educate and empower you on that. So, all right, let's jump in to the November edition of our market update. Here's an outline. Sometimes I talk fast. I go through a lot of slides, but really 5 areas I'm going to hit today on the webinar. I'm going to start by talking about the markets, and then I'm going to shift to talking about the economy and interest rates. I'm kind of sandwich those together because they really are 2 sides of the same coin, if you will. And then I will end with some year-end updates, really more what our team is talking about with clients, what we're thinking about internally as we think about financial planning, investment management. Next month, I'll do more of a forecast for 2024. Probably December and January, we'll do more of our forecast outlook for 2024. And then I'll wrap up with some Q&A. So again, please enter your questions if you have any in the chat, and let's dive in. All right, this is a chart. Again, I am going to show you several charts, so I hope you don't get too lost. But visually, one of the things I want to explain here is this is the stock market. Typically, when we show charts on the stock market, we're talking about the S&P 500. Now, whether you're a huge investor in the stock market or whether you are a casual investor in the stock market's a good indicator of where the overall economy is going, whether that's real estate, whether that's gold, whether that's stocks, whether that's consumer spending on that. So one thing I want to show you on this chart here is this looks like a kind of a erratic scribbly line here. This goes back to the early 80s, mid 80s here on this. But this horizontal dotted line is the historical average for the stock market and what we call price to earnings ratio. And what that means is this red line here in the middle, if the line is below if that dark line, the kind of the squiggly line, if it's below the red dotted line, then the markets are undervalued, right? So you see here in the middle of my screen, the financial crisis of 2008. You can see that what we call it the PE ratio, price to earnings, was very, very low. And likewise, in the late 80s, if you were around investing or working then, we had the market crash of 87. You can see that was very, very low as well on that. Now, the point here in this chart is that investors really need to exercise caution because the market, the stock market, is still what we would consider richly valued. The PE ratio is somewhere around 17 or 18, and the historical average is really closer to around 15 on that. So again, what do we glean from this? We glean that we want to be long-term investors, but we also want to recognize when are assets overpriced and underpriced. And you can see even after the big market correction of 2022, the markets have done pretty well this year in 23 and come back quite a bit. Now, I want to pause just for a moment here, and I want to put up a poll question here, and this helps me. So I'm putting a poll question here. You should see it on the left. How would you describe your investment experience? And again, I recognize everyone's on different parts of the journey from, hey, I'm a beginner, I'm intermediate, pretty involved, to, hey, I've been investing for a long time. So take a minute and just give us some feedback there on, beginner, intermediate, advanced, as far as what you feel like your level of investment experience is on that. So, and that's helpful for me even as I kind of show these charts. All right, again, I'm talking about the markets for this part of the webinar. And one of the things on the markets, and we have the U.S. markets, we have international markets like developed countries such as Europe, and then we have emerging market countries such as India, for example. Now, this chart here, again, all I've done is I've carried over that same line graph, right? Here's the one when I was just showing you about how that the U.S. stock market is still overvalued. And I just brought that over to this next chart. So this black or dark blue line at the top, that's the U.S. stock market. And the red line is what we call the international or developed markets, developed economies, such as in the UK and parts of Europe, Germany. And then this orange, kind of yellow-orange line is emerging market countries. So now one of the key takeaways is that despite having a bear market last year in the US stock market is still the most expensive in the world. So when we compare these numbers, again, we're measuring how overpriced or underpriced things are. What's the value proposition on that? And you'll see that international stocks, companies, public and private companies in international countries, in emerging market countries, are still actually cheap compared to US stocks. So, again, I've mentioned this in past webinars, but one of the things that we are looking at is, well, some of these are good companies. They don't violate our values. We like their business models, and they're less expensive than some of the companies here in the US. So if you're a value investor, then one of the things that you want to look at is, well, where are things cheaper, relatively speaking, where you're still buying good quality assets, but the cost of them is lower. And right now we're seeing some opportunities starting to come about in these developed countries and emerging market countries on that. So again, if you're taking notes at home, you can expect to see that on the 2024 market outlook, that'll be one of our themes for next year, is looking for opportunities in some of these developed and emerging countries on that. Well, let's keep moving along. Thanks for answering the poll questions. Over 50% of you all, over 55% of you all identify as a beginner investors, and then a pretty good amount as intermediate, and then a handful of advanced. So we've got a good mix there. And whether you're a beginner, an intermediate, or an advanced investor, you know that the markets go through cycles, whether it's real estate or gold, commodities, or stocks. And this chart is one I wanted to put in here today because our team at Wealth Builders Investments, we do get a lot of questions on this of, well, the sky's falling, we're going into a recession, we're going into a bear market. What should be our view on how we manage our portfolio? Now, you know, some of the most successful investors of all time, like Warren Buffett and Charlie Munger, they make money when people are fearful. And so what this chart shows, I like this because going back all the way to 1980, you'll see these vertical blue bar graphs. Okay, does everyone see that? So what those blue bar graphs show us is that is how many times in a given year that there was at least a 10% decline in the S&P 500, right? So again, the stock market's a great thermometer for what's going on in the overall economy and all the other capital markets. So small business, real estate, and so forth. Now, what you'll see is clearly there was like 10% pullbacks in the 2007, 2008 financial crisis. On there, you go back to the 2000 and the Y2K bubble. There was, 3 and 5 for quite a. That was actually the year I got into the industry. There was a lot of volatility, and I remember that quite well. Now, but what you see is that it's not uncommon for there to be 10% pullback every year, every other year. Right now, obviously in 2020 with COVID, we saw a lot of volatility, and that's why you see that number so high on that. So again, my takeaway from this chart is that if you're a long-term investor, this orange graph is just the market. So there is a basis for being a long-term investor, that you do ride the waves through volatility. Now, if you've heard me speak much, I'm not a proponent of just buy and hold, put all your money in mutual funds or stocks, and don't ever rebalance it, don't ever make changes. I do think a lot of people out of Wall Street have that opinion. But again, you want to be smart, but you also don't want to sell all your investments when the market has a 10% decline. You might pivot and rebalance, right? Just like you take your car in for alignment, rotation, but you don't sell the car altogether, right? Same concept. And what I really want to instill in you is you have to think long-term mindset for how you manage your resources, whether you're running a business, entrepreneur, or whether you're just investing for college, for retirement, for general wealth accumulation. You don't sell all your investments when you have high volatility. What you do is you look around at the environment and you see, well, where are the opportunities right now? We have a 10% pullback pretty frequently. What are some opportunities to get into different investments? That's the key that I want to instill in you. What we battle as financial planners and advisors is a lot of people really get on the side of fear. Financial management is a continuum of greed and fear, right? And so biblically thinking, we cannot let money have mastery over us. We need to be stewards of it and good managers of what we've been given with our jobs, our families, our businesses, our financial resources. And we really need to have a neutral approach to where we're not overly emotional either way with greed or fear, but we have a plan and we can look objectively at, okay, this is happening in the market. What does it mean that interest rates are higher now? What does it mean that there is an oil crisis, for example? How do I take advantage of that? That's what the wise investor does. All right, let's keep moving ahead. I love that chart. I actually had not seen that one until recently. All right, I've got maybe one or two more charts on the markets, and then I'm gonna move ahead into the economy and interest rates, and then we'll finish up with some of our year-end planning thoughts and some Q&A from the group. So please feel free to get your questions in the chat. And let us know what questions you have. All right, this chart is what I call the periodic table chart. And I love this because it shows us the benefits of asset allocation. So one of the things we preach when we're working with families is really what Solomon said in Ecclesiastes 11:2. King Solomon, son of David, was the wisest and wealthiest man who ever lived, outside of Jesus himself. And what he said was, you should invest in 7 or 8 different ventures, for you know not what will come upon the earth. Now, fast forward to the 20th century, and people like Harry Markowitz and all these other great financial minds have done all these independent studies on what we call modern portfolio theory, which I had to learn in business school. But what they learned is what Solomon said was actually true, and that in order to have the best risk-adjusted return for your money over the long term, you needed to be diversified in 6, 7, 8 different asset classes. So this chart here, the different colors, just to give you a little framework here, that just shows you different types of assets you can invest in. Now, it's not covering everything, but what I want to point out is down the middle ribbon there from left to right, you see is all red, and that is the S&P 500, which if any of you invest in a 401k or an IRA or a brokerage account, many of you may work with companies like Edward Jones or Merrill Lynch or Northwestern Mutual, great companies, great employees who work there. You're most often going to be put into just what we call the S&P 500 market. Maybe it's an index fund or an ETF. Many of you may self-manage your accounts. I talked to a good friend and client earlier, and we help them with some stuff, but they also self-manage many of their investments. And I would say 90% of people are going to be in just this red box. Now, what we're showing you here is that, going back over the last 15 to 18 years, the S&P 500 returns, there are going to be times when different asset classes outperform the S&P 500, right? So again, it's really the merits of, even you're not going to miss out if you diversify. What you're actually going to do is help keep yourself in the game. So Billy Epperhart often says, hey, you got to get in the game. Well, I would further that statement by saying you got to stay in the game, right? Because if you get into investing in stocks or gold or real estate or starting a business, and then it doesn't go well, what generally happens is we shy away, we pull back, right? And for obvious reasons, which are very understandable. I've done it myself. But if you have kind of this Solomon approach of, hey, I'm going to be spread out in a lot of these different color boxes, so that when you have a large economic collapse or recession or interest rates do something, you have certain things in your portfolio that will do well. You have certain things that will not do well, and you have certain things that'll just kind of stay neutral on that. That's really the secret sauce to staying in the game when we think about a well-balanced portfolio. All right, let's keep moving along. One of the things that I showed you was this red box, the S&P 500. Now, one of the largest misconceptions in stock market, Wall Street investments is that, hey, Chad, if I invest in an S&P or an index fund inside my 401k or my IRA or whatever, I'm going to be very well diversified. Well, I covered this last month, and I finally found a chart that I really like that shows this really good. I mentioned that there are really 7 stocks within the S&P 500 that make up all the returns of the S&P 500. So if you are in SPY or some of the other major indexes, you're really just in 7 different companies. Meta, which is Facebook, Amazon, Apple, Alphabet, which is Google, NVIDIA, Microsoft, and Tesla. Okay. So what this is telling us is, if you are in these in the market, you're really just in these 7 companies. Now, here's an interesting fact. Those 7 companies last year in 2022 were down about 50%. And that's right here on this chart. Just those 7 companies were down 47, 48% last year in 2022. So let me ask you a question. If you were down 47%, would you hold on to those investments? Now, I've got a pretty good sampling size from 20 years of working in this industry and working for hundreds of amazing families. And psychologically, very few, I would say less than 3%, maybe even lower than that, would keep an investment if it had gone down 50%. However, look at the other side of this chart. If you're looking at the middle of my chart here, you see there's this V. So last year, those 7 companies were down almost 50%. This year, 2023, they're up about 100%. Now, if you were wise enough to stay in, then you would do fine. But if you wrote it down and sold it down here, you'd probably have a little bit of indigestion on that. Again, the key takeaway here is that just because you're invested in the broad market does not mean you're diversified, A, and then B, you're actually, it's not that you're not only not diversified, you're very heavily concentrated in these 7 technology names. Some of these companies we do not invest in from a value proposition standpoint. We don't want to support some of the things that they stand for. Some of these we're okay with in certain situations on that. However, again, we're talking about staying in the game when it comes to the market. Now, if we have a full-blown recession going into 2024, technology names like this, that will repeat itself. They will probably go down 30, 40, 50% again. All right, I'm going to skip that chart. I want to make sure we save time for questions. Again, talked a little bit about the markets. Now I want to shift to the economy and interest rates and kind of weave that together, give you some real specific feedback. I know many of you, probably one of the number 1 questions we get right now is what's happening with rates and how is that affecting the markets, whether it's stock market, whether it's real estate market, and so forth. So let's dive into that now. All right. This chart here just shows the U.S. economy going back to the early 70s. So it's a pretty long chart, but what it shows is these bar graphs are the growth of the economy. So you and I, everyone in this meeting today, we represent about 2/3 of the economy by what we spend. So whether we go out to eat, or if we go to Costco, or if we take a trip, if we buy a car, if we buy a new iPhone, whatever it is, that is what drives 2/3 of the economy. Now, of course, historically, the U.S. economy has grown at about a 3% rate every year, going back 50, 60 years. Of course, you'll see here this huge outlier. That was COVID. So obviously, when the world stopped in 2020, the economy shrank significantly. And then when it reopened, it shot back up significantly. Now, what's happening right now is the Federal Reserve has been fighting. And if you see here, right after COVID, you'll see that the growth of the economy was actually very strong. And what the Federal Reserve was concerned about, now again, I'm talking about the economy and interest rates right now. What they were concerned about is that the economy was running too hot. It was growing too aggressively on them. So that's part of why we saw the Fed so aggressively increase interest rates on that. Now we actually did see 2 quarters of negative growth there, which is technically how you define a recession. But what we've seen now over the last several quarters, and in fact, what the quarter we just came out of, the third quarter, the economy is growing at almost a 5% annual rate. Now that's starting to get hot. And so that's part of why, and I'm going to show this on a future slide here, why interest rates are having to stay as high as they are. Now, this next chart I want to show you it's called a financial conditions index. And these gray vertical lines are recessions. And I know I'm getting a little technical here, so just hang with me. I'm going to show a couple more slides, and I'll talk about kind of what we're doing, what we're talking about with clients, and kind of go from there. These gray vertical lines are recessions. So even going back to 1990 and the Gulf War, the financial conditions index, when it is at a very high level, you see we've kind of noted some of the different ones, the 2000, the dot-com, 2008, mortgage crisis, we had COVID, and then where we are today. You see the question marks there on that. So again, I use the term financial gravity. So typically on these charts, what you see is that when this financial conditions index gets really high, it is almost always associated with a recession. And over time, they regress to the mean, which is this green, red dotted line there, kind of horizontal declining line on that. So every time we've been in a financial conditions of this size, we've seen either a mild to moderate to severe recession on that. So I want to open up my second poll question just to get your feedback. Make sure you're still with me there. And this one's on the economy. And what I want to ask is, do you think we will experience a recession going into 2024? Now, I've kind of showed you my slide here on some of the things historically when we've been at that measure. This is a lot of what the Federal Reserve, policymakers, bankers are really wrestling with is, will we see a soft landing, as they call it, with the economy and interest rates, or will we, as a lot of these things seem to point to, will we see a recession going into 2024? Still got a lot of answers coming in on the poll. I would say the majority of everyone believes that we will, around 80%, believe we will see a true economic recession in 2024. I would agree with you. I would vote yes on that. I'll talk a little bit more here in a minute on some of the things we're doing or thinking of how we will navigate that. All right, I'm going to skip this chart. I'm not going to stay here long, but this is the measure of inflation. And so when we think about a recession, we have to think about inflation and what impact that's having. Now, inflation has been coming down. And so you'll see here, inflation was really high coming out of COVID. And then the Federal Reserve has effectively lowered inflation from 8-9% down to 4%. And even some of the numbers that came out this week, less than 4%. So that's good. Now, what you have to understand is that this measure of inflation doesn't include things like energy or food cost. I mean, if you go out to eat, if you're buying groceries, you know, those things cost a lot more than say a 4% rate of increase, as does energy for that. But again, this is what the Federal Reserve is fighting. And so I put in this chart here. I didn't have it, but then this news came out here a couple days ago. On the 14th of November, inflation reports came out that the CPI, which was a chart I just showed you, was flat for the month of October, and that it increased 3.2% from 1 year ago. So these were both well below what Wall Street was estimating. And what happened this week is that it sparked a major rally in equities, in stock prices on that. The other thing that happened is bond yields came back down. So the stock market had a big rally on this news, and bonds also responded favorably in that bond yields came back down. Now you might be saying, Chad, I don't even know what that means. What do you? What's the takeaway here? And what the market is now interpreting is that the Federal Reserve is most likely done with future rate increases. Not expecting to see a rate increase in December. And in fact, let me show you this next slide. Based on the economic data that came out this week, here it is here. This chart here, this is currently the federal interest rate at 5.25%. Now you can see we've been on this wild ride. And so if you've been looking to buy a home or buy for personal or investment purposes, you've seen rates have just gone up and up and up and up. Now, this is what's being projected, is that we've reached the apex of rates. There's probably a less than 20% chance we see one more rate increase, which is what that little black diamond is there. But as of November 15th, as of yesterday, we're predicting that rates are going to slowly go back down, but they are going to stay higher for longer. So what you'll see here is we're not going to get back to rates, as low as they were, but we're going to get back to a equilibrium number on that. And that, in our opinion, is very good news. Let me skip ahead. I want to show you this chart here. So here's really what we're forecasting is rates are high, and we think going into next year, potentially as early as April or May of 2024, that the Fed will start to slowly lower interest rates. Again, to get us more over the next year to 18 months, you'll see this chart goes out to 2025, that we'll see the federal rate go from 5.25% down to potentially, 3.8, 3.75% on that. Now, that's our view of the economy and interest rates. So let me summarize those charts because I kind of went through them fast. We're expecting the Fed to not raise rates on December 13th. And then there's Fed meetings in January and March of 2024. Right now, what the bond market is saying for everyone, and this is helpful, and I'm gonna make the application here in just a minute, just to help connect the dots, is they're not going to raise rates going into the first quarter, and potentially by May 1st, going through the summer, we'll start to see interest rate cuts. And I think there's two reasons why that'll happen. One is that inflation appears to be under control, and we've kind of reached the threshold
of which the amount of higher rates that the consumer can handle. The second reason is, as you all well know, 2024 is a presidential election year. And say what you want, but I think policymakers will be very accommodative, which means uh, cutting rates a little bit going into the election. Um, Read into that what you want. I just think that between those two factors, the economic data and it being a presidential election year, that's going to bring some relief to the interest rate market. And I'll make a couple of applications here on why we think that is important to you. So with that, I want to transition here to, okay, Chad, you gave us an overview of the market and diversification. We talked about the economy and interest rates, very intertwined. And now I want to really give you some application. Sometimes when I do these and I don't have live interaction, I feel like, gosh, I've covered way too much content, way too many charts. But what I want you to walk away from is some actual context for, okay, I think I learned some things here with you, Chad, but what's the application? So let's dig into that right now. All right. So here's some things to consider. One, we are projecting interest rates based on the economic information that came out this week are going to start going down. We've already seen the 10-year bond yields come down. We've already seen mortgage rates back off a little bit as well. Mortgage rates were as high as 8% or north of there, and they've come back down a little bit, as has the 10-year U.S. Treasury bond. Now, what that means is going into 2024, one, the stock market has rallied, as I mentioned earlier. So that's been bullish for stocks. And the lower rates, forecasting of lower rates means that mortgage rates should settle back down. And I think as we think about real estate as an industry for 2024, and we get back into the spring and summer seasonality of that, I think that's going to be helpful. So if you're looking, again, my opinion here, if you're looking as a first-time home buyer, if you're looking to add to your investment portfolio, I think there's the potential to see higher inventories in the spring because rates are going to be a little lower. They're not going to, it's not like we're going to see 5% mortgages, in my opinion, but we should not be at this 7.5% to 8% 30-year mortgages. That's going to help on the affordability, and I think that will help with inventory in a lot of markets as we head into the spring. Now, it also means the second point here, applications, is the effect of lower rates on fixed income investments. If you haven't already, and I've shared this in past webinars, if you have not evaluated what your cash savings are earning at the bank, at the credit union, at your financial custodian, I encourage you to do that. At Wealth Builders Investments, we can certainly help you evaluate that, but I would be, if I'm an investor, I'm going to be making sure I lock in some good fixed income rates right now while rates are high. You can get 5.5% on risk-free assets right now. So I'd encourage you, hey, create a plan for doing that. If you're looking on the real estate side, it's more getting ready for those opportunities because lower rates there help. And on your fixed income investments, you just want to make sure you're dialing in the higher rates that help you on the investment side now. So that right there, two key takeaways if you get nothing else on the investing side, fixed income investing side, how to handle it, and on the real estate investing side, whether it's for personal or investment purposes of here's what we're seeing. And we're heading into the holidays. That's going to go by fast. We'll be getting into January, February, and then before you know it, it'll be March 1, and it'll be kind of seasonality for that. So I want to lock in higher fixed rates on my investments, where that's a part of my allocation. And I want to just ride this out a little longer on my real estate goals for personal real estate. All right, I showed this slide before. I wanted to give you an insight. Many of you are clients, some of you are new friends, old friends. Thank you again for being here just as we start to wrap up the webinar. But I like to give you an update playbook on what we're doing. Now, again, I'm not going to give you all the secret sauce, but I want to give you some tangible takeaways of, well, Chad, how are you and your team? How are you navigating the markets? What types of things are you looking at to invest in? This has not changed from last month, but I do want to reemphasize some of the points on that. Now, I'm not giving you specific investment advice here. I'm going to show you in a minute the way to schedule a one-on-one consult with the team. I'll give you that link here in the chat here just in a minute, as well as the link to download the slides on that. Again, I already mentioned this, but point one, we're very focused on just short-term fixed income. So we want to be locking in those higher rates, making sure the money that we're going to be most conservative, that we need the most liquid, that we have the highest rates on that, whether that's a money market, whether that's U.S. Treasuries or insured CDs on that. Again, I think that's an important takeaway. And then we also are investing in the private credit markets. I don't have time to explain that, but that's a little different than the most liquid fixed income. Typically, private credit is a type of fixed income. You generally have to commit your money for 18 to 24 months, but you can get a little higher rates of return than you will on your CDs. So a combination of those two things we like. Again, it's definitely going to be, what is your personal strategy? Everyone's going to be different. But those two things we focused a lot on here at the end of the year. I'm not overly worried with the market rally this week. We have continued to take a wait and see approach. We do think equities are highly overvalued. There are selectively equities that we like, that we're investing in, higher quality, dividend focused companies, strong cash flow, right? But overall, we are still underweight equities. I think right now, I don't want to be putting new capital into the stock market when the S&P is at 4,000, 4,300, 4,500, and so forth. I really want to wait for a pullback. I do think as we head into the holidays and into January, I think the probability of seeing another one of those 10% pullbacks that I showed you on my chart, I think that that grows. So again, I'm not going to be overly greedy or fearful on that. I'm going to take a very cautious approach on where we're investing in equities. And also I'm going to be looking at international. I don't think I added that here, but we are going to be looking at more international opportunities because of the chart I showed you earlier, where there's a little bit more value there, if you will. The last part of just kind of our playbook and some of the things we've been doing, we do like non-correlated investments, things like oil and gas, wildlife conservation, private equity. And those are things that we want to make sure we're investing like Solomon, where we're very diversified on that. So again, those are things we're happy to talk with you about one-on-one. Again, we're looking for cash flow. We're looking for tax benefits. We're looking for things that diversify us beyond stocks and bonds on that. We also do have on the private equity side, we have started a private equity investment we call the Solomon strategy, where we're looking actively for opportunities to invest alongside private companies that are run by teams, CEOs that match our value set, but also that have significant growth potential and significant social impact on the world. So that we call that the Solomon strategy. Happy to talk with you all about that. All right, before we wrap up here, I want to provide a couple of links here for everyone. And so you can see that. And then I'm going to look through some of the questions here on that. So let me do this. I'm going to share our offer here. If you want to talk one-on-one with our team, I've put a link there in the chat. I'll be happy to visit with you all. Some of the things we're talking about here, so you can click on that green box that says schedule your consult here. Here's a chart. It's my last slide. Here's some of the things we're talking about with folks. Year-end giving, evaluating your retirement accounts and what you're doing with contributions and RMDs and Roth conversions. Cash reserves. How are you managing your cash? Evaluating your insurance, whether that there's all types of insurance, and then just thinking through those items and creating your plan to go into 2024. So if any of those types of things, or if you just say, hey, Chad, I'd love for your team to just do a second opinion of where I am with my investments, or you may be current clients and say, hey, Chad, I want to touch base with you and the team before we get fast and furious into the holidays. Just hit us up here on this scheduling link, and we'll carve out some time to check in with you, whether you're current clients or whether you're new to our network on that. So again, I'll leave that up again under the offer column. Click on that. And then let me wrap up here with some of the questions that have come in. Let me answer a few of those here in just our last few minutes on that. Again, yeah, we will be doing a formal market forecast for 2024. That'll be at next month's webinar. So this was more kind of looking in the rearview mirror, and next month's we'll cover that extensively. So thank you for that question. There's some good questions in here. Again, someone asked a question about BlackRock. We do not invest in BlackRock related funds. They are definitely on our naughty list. We don't agree with their values, and we don't want them voting our proxies for that. So one of the things we do with Wealth Builders Investments is our portfolio is designed around non-BlackRock companies. That's hard to do, but we have spent a little more on internal research to do that. We will be sending a link. So this webinar is being recorded, so you will get this. If you registered for it, you're going to get the link for that. Someone was asking about gold and silver. We do like gold and silver. There's several ways to buy it. You can buy physical. You can buy it in your IRA. You can buy what I call paper gold through like an ETF. It's a little less expensive and easy to track and easy to trade on that. I would say personally on gold and silver, again, it varies across your suitability and your goals. I would say, having 5 to 10% in gold and silver. I do know people who have more than that. They might have up to 20% in gold and silver. I think for me personally, I would probably lean more to having 5 to 10% in those type of hard commodities, that being gold and silver. And how you do it, really personal preference, if you take physical receipt of it or if you just buy it in your IRA on that. Great question. Thank you for that. As far as emerging markets and developing markets, the best way to invest in those companies is going to be typically through ETFs or index funds. And what we have at Wealth Builders Investments is we have a menu of those funds that we like, that we've screened. We believe they have low fees, they have good track record, they're in the types of markets that we want to be in the international and emerging markets. And we also screen them for values. And so we do screen out some funds in emerging markets, international, that have great performance, but they violate some of our principles and ethics. And so we filter them out. And there's other good ones, just as good. All right, let me comb through here a little more. Had some questions about digital currency, Bitcoin. I always know when I get clients emailing me about buying Ripple or buying Bitcoin, that's probably the time to sell. It's a contrarian indicator. We have tried investing in digital currency for clients, and if I had my team on here, they would agree. It is such a volatile asset that people inevitably cannot handle the heat. I do think if you can hold some Bitcoin, Ethereum for 5 years, I think you're going to be glad you did. But I have found personally that most people, when we have done crypto and digital in the portfolio. They just cannot stomach the volatility. And I get it. So I think if you've got some play money and you want to go open up an app with one of the credible providers out there, I don't have a problem with that. I would not put your down payment for a house or your college fund for your kiddos in that. But digital currencies are here to stay. Decentralized finance, we could do a whole webinar on that. So I do like it. I do invest in it personally. I think right now it's had a huge run up in the last few months, and I would expect to see a correction in that. Like I said, when I have clients emailing me and I know they're not suitable for it and they're saying I'm going to go invest in it, that usually tells me it's probably not the time to buy. So I'd probably wait right now. I'd probably wait for a little lower prices on that. Hey, great questions. If we didn't answer your question, please reach out to us. Again, a couple things just in closing. We do have under the offer tab, if you want to talk with our team, we've got some great advisors. We'll be happy to visit with you, either myself or Caleb or another team member. If you're current clients, you know how to reach us. You can contact us through the schedule link, or if you're a current client, feel free to reach out to me directly. If you have any needs or questions, we are here for you, and we're thankful for you this year. And again, feel free to hit that link. And then let me lastly close with sharing the handout. I meant to do that earlier on that. So you now have a tab with the handout. It says click here for your webinar handout. So before you jump off, click the webinar handouts. That'll give you a pop-up for the PDF of the slides I shared today. And then secondly, in the offer tab, take a moment to schedule that as well on that. Hey, this has been good. I know we covered a lot of content today. I appreciate the questions. I want to wish everyone a very safe and happy Thanksgiving, traveling and spending time with friends and family. And we're really thankful for you. And so please continue to follow us on these webinars. This type of webinar is every month, typically the second Thursday, depending on my schedule, we do that. And then please check out the Kingdom Finance Show, subscribe and follow us there. We have new episodes that drop every week. And yeah, we really appreciate your time. Get the handouts on the download link and then schedule your consult. If you just want to learn more, maybe you're new to us, you haven't heard me or the team, you want to learn more about how we work with families to create a kingdom-based, a values-based investment approach. We'd be happy to tell you more about what we do. We do have some capacity right now to work with new folks here at the end of the year. End of the year is usually pretty busy with everyone's schedules, but we would love to visit with you. And thank you so much for being here. Thank you, current clients and friends, for supporting us. We value you, and please reach out to me directly if we're already working with you, if you need anything whatsoever. So with that, I'm going to sign off. Thank you again for being a part of this month's economic update. And I'm Chad Frantzen on behalf of our entire team at Wealth Builders Investments and Kingdom Finance Show. Thank you, wish you well, and we will speak to you soon. Bye-bye.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.